Good afternoon, or good morning, or good evening, wherever you are. Today I want to talk about the quarterly demand forecast for industrial space. So I'm Tim Savage. I'm a professor here at the Shack Institute. I'm also the faculty director of the newly created CREFC Center for Real Estate Finance, as well as being a distinguished fellow at the NAIOP Research Foundation. Had a quick chance to look through participant list. Good to see some former students. Many of you know who I am, my background from running CBRE Econometric Advisors. And what I'm going to do here is essentially show you what I did there. So I want to talk about the quarterly demand for industrial space. And to get to that point, I need to talk about macroeconomics. The macroeconomics of Knightian uncertainty, the macroeconomics of Keynes, the macroeconomics of Bagehot, names that you may or may not know, but names that are very important at the moment. So I want to step back to 1929 and the Great Depression. And in the fall of 1929, equity markets in the US declined by about 30%. And at that time, policymakers had little or no data. And as a result, we would create things like the national income and product accounts, these government statistics that measure output. And we would do lots of exciting things, creating so-called large-scale macroeconometric models for forecasting, as well as develop a number of interesting microeconomic approaches. But today, the Federal Reserve now relies on real-time data when they are making policy decisions. And that's very important because this entire talk can be distilled into 2 bullet points. Policymakers had little or no data in 1929. And today, the Federal Reserve relies on real-time data to make decisions. We also have to recognize that commercial real estate was faced with tech disruption before COVID-19. We had seen the economics of agglomeration very much assert itself in the last economic expansion, which drove urbanization, drove density in cities like London, New York, San Francisco, Shanghai. E-commerce was disrupting retail long before COVID-19 occurred for one simple reason. Retail is a distribution mechanism. It isn't like office space, it isn't like industrial space. It is simply a means to move goods from producers to consumers. And e-commerce, as a matter of economics, is a more efficient distributional chain. And consumers have demonstrated in this crisis their preference both for that economic efficiency as well as the need to shop remotely. And then finally, co-working and optionality as we think about office space. Setting aside what happened at WeWork, in fact, there is option value to co-working. There's option value to short-term leases. And the question there is whether tenants and landlords can mutually share the value of that optionality. And again, students of mine have seen the toy economic model that I have on this idea. And so there is value to optionality, and co-working is not going away. All of this was essentially being driven by tech. Tech was driving job creation in dense urban locations. Tech was driving e-commerce. Tech was driving co-working. And I would argue that COVID will accelerate these disruptions, obviously as a probabilistic forecast. Because we have to recognize capital allocation in commercial real estate is primitive. It is like trading bonds before the Black-Scholes-Merton model existed. And essentially, algorithms will begin to be deployed as returns in commercial real estate fall. Setting aside COVID, commercial real estate returns will fall for a very simple reason. The supply of commercial real estate is largely fixed. The demand for it is increasing. That should drive up its price and drive down its returns. And therefore, we will deploy algorithms to help us deploy the capital in this industry. Again, tech will continue to disrupt commercial real estate, and I would argue that COVID-19 will accelerate these disruptions. So let's talk about the current economic cycle. Long duration rates, arguably the opportunity cost of capital in commercial real estate, have been falling for a very long time. This is the 10-year US Treasury going back to 1990. You can see in this chart, in 1990, the 10-year US Treasury stood at over 8%. It is now hovering in and around 70 basis points. This is the most liquid market in the world. And this long-term decline in long duration rates represents a decline in the opportunity cost of capital in commercial real estate, and arguably a risk-free rate or a risk-free measure of returns in commercial real estate. Long and short-term rates have largely decoupled. This graph shows three interest rates, 2 short-term interest rates in red and green, and again, the 10-year US Treasury. And you can see these rates have become uncoupled. Economic theory tells us that there ought to be a relationship between short and long-term interest rates. And to the extent that theory is correct, that relationship has broken down. And you can see this visually in the graph. The red line reflects Lehman Brothers bankruptcy in the fall of 2008. Importantly for us at this minute, the yield curve has been flat or negative for over a year and a half. This is the yield curve, 10-year minus 3-month US Treasury, going back to January of 2019. This yield curve has been flat or negative for a substantial period of time. We know from research that this is a forward-looking measure that reflects economic activity. Markets have been pessimistic about long-term growth for over a year. In turn, long-term inflation expectations have collapsed again. This is the break-even inflation rate measure, essentially the market's expectation of inflation 10 years from now. This series goes back well before the global financial crisis. You can see when Lehman Brothers failed, inflation expectations collapsed. In the face of COVID, they largely did the same thing. And frankly, US GDP growth has collapsed. This is a measure of US GDP growth going back to about 2000. This is quarterly data that I've annualized. You can see at the depth of the global financial crisis, the US economy was shrinking at about 4%. If we annualize the contraction in the US economy in the second quarter of this year, we are talking about depression level contraction. So what happened? What occurred from the perspective of policy? At the Federal Reserve, they tried their old playbook. They tried their traditional mechanism of lowering overnight lending rates, lowering the Fed funds rate. This is a graph of the Fed funds rate going back to the beginning of 2016. You can see when Powell took over, he began raising rates. And we all know what the reaction from the White House was from this. He then changes course, begins reducing the Fed funds rate. And then in a Sunday meeting in the spring, March, I believe, they announced that they were reducing the Fed funds rate to 0. Technically, this number cannot go below 0. So they're trying their old playbook again by reducing short-term interest rates with the hope of reducing long-term interest rates, with the hope of spurring investment. The immediate reaction of equity markets in the US was stunning. This is the Wilshire 5000, a measure of broad market equity going back to the beginning of the year. It had reached a peak just prior to the first announcement of a death from COVID in the United States. And you can see equity markets contracted very rapidly, very reminiscent of the fall of 1929. But they have largely recovered. And I want to give plenty of time at the end of the presentation for you to ask questions. I have thoughts as to why equity markets have recovered in the face of COVID. And in turn, volatility in markets has receded. This is a measure of market volatility, again, going back to prior to the global financial crisis, Lehman Brothers bankruptcy in red. You can see volatility peaked just after Lehman Brothers bankruptcy. We saw the same level of volatility in the spring in US equity markets. And when I talked about the macroeconomics of Keynes, I was essentially talking about the paradox of thrift. This is a measure of monthly sales of food, beverages. It's a real-time index that many economists use to gauge consumption. And you can see the stark decline that occurred once the lockdowns began in March and April of this year. And the paradox of thrift comes from this basic economic idea that my spending is your income, your spending is my income. It may be optimal for both of us to reduce our spending in the face of a natural disaster. But the paradox of thrift basically says that we are both made worse off as a result of this. And the velocity of money has collapsed. This is a measure essentially of how rapidly a dollar bill moves through the economy. And you can see it has been falling like long-term interest rates for some time. But when COVID hit, it collapsed. In turn, employment growth collapsed. This is quarterly employment growth, again, annualized, going back for quite some time. And you can see during the global financial crisis, marked by red, Lehman Brothers bankruptcy, that employment growth contracted quite a bit during the global financial crisis. But the current crisis is an order or two larger than what we saw in the global financial crisis. And we continue to see in the US accelerated or elevated unemployment claims. This is a measure of first-time unemployment claims going back to the beginning of the year. You can see that they peaked at nearly 7 million. This is a weekly measure of new claims for unemployment insurance. At its peak, it was 7 million people in 1 week. Even through today, this measure stands at about 1 million. And this is unprecedented. Even in the global financial crisis, the worst week of first-time unemployment claims in the global financial crisis was about 800,000. And we continue to see that in the current crisis every week. And then this now obviously is reflected in unemployment rates. This is the U3 measure of unemployment in the US going back essentially to when this series was created. So This is data that was created because we lacked data in 1929. And this series goes back to the beginning of the national income and product counts. You can see the peaks that are concurrent with US recessions. This peak, the U3 measure, peaked at over 14%. It's starting to come down, but it is still elevated relative to the global financial crisis or the very deep recession induced by the Federal Reserve in the early 80s to get a hold of inflation. So what are the macroeconomic implications of this? Who are these people that I talked about? One macroeconomic implication is that investors have remembered Frank Knight. Frank Knight was an economist who helped us to see that there is a distinction between risk and uncertainty. And his basic definition was risk can be measured, but uncertainty cannot be measured. And a first order approximation to uncertainty today is a lack of data. And we can see this now as investors move into cash. This is a measure of the amount of cash sitting in money market mutual funds in the US, again, going back to about 1990, peaked in the global financial crisis, but now stands at $4.5 trillion. So investors are reflecting Knightian uncertainty because they are maintaining their holdings in the most liquid instrument they can find, which is a money market mutual fund. In turn, the Federal Reserve remembers Bagehot. Walter Bagehot authored a great textbook on what central banks are meant to do and talked about central banks as the lender of last resort, that their function was to lend freely, but with a penalty against good collateral. And in essence, the phrase didn't exist back then, but in essence, Bagehot talked about liquidity. This is a measure of the Federal Reserve's balance sheet going back to 2000. So prior to the global financial crisis, the Fed's balance sheet simply reflected its holdings of short-term US debt that it used to buy or sell in order to influence short-term interest rates and arguably long-term interest rates. In the global financial crisis, it would acquire the debt of failed institutions like Bear Stearns. And then these subsequent increases you see are what we call quantitative easing. And it leveled out at about $4.5 trillion. Because much of this balance sheet is debt, that debt matured or was written off. And you can see prior to the arrival of COVID, the Fed's balance sheet was actually declining until this time last year. For the first time in years, the Federal Reserve had to step into overnight lending markets. That first initial blip you see after the decline arose because the Federal Reserve was intervening in overnight lending markets. There were many, many signals in the market prior to COVID. And then essentially the Fed announced that it would acquire every sort of debt instrument one could imagine. And they expanded their balance sheet to over $7 trillion. Again, acting as their more traditional role as the lender of last resort, rather than the modern role we think of as trying to influence interest rates. And in turn, the federal government remembers John Maynard Keynes, who basically argued in situations like this, where we face the economics of a liquidity trap, where traditional monetary policy has no traction, we have to see fiscal policy. We must see spending on behalf of the federal government. This is a measure of fiscal deficits. Anything above zero shows a surplus. Anything below zero shows a deficit. When this number is updated, it will exceed the depths that we saw during the global financial crisis, as the US government has essentially committed to about $3 trillion of spending in this year alone. And this is occurring in a world of public leverage, right? A deficit is a flow, debt is a stock. This is basically the amount of public debt in the US as a share of overall US output. And you can see this now exceeds 100%. By the time this is over, this number will probably exceed 120%. Albeit during a time when the private sector is deleveraging. This is a measure of private sector debt as a share of GDP. You can see it peaked at the global financial crisis, but firms have not been taking on leverage, not been taking on debt since the global financial crisis, and that's in particularly true today. So I would argue the similarity between 1929 and today should be fairly obvious. We have returned to an absence of data. And that absence of data is driving the 19 uncertainty, which in turn has driven investors to the most liquid assets they can find, which is US Treasuries or cash, which in turn has accelerated the decline in long-term interest rates, as well as to have put the Federal Reserve in a position where it must recognize its traditional role as a lender of last resort, to provide liquidity to markets, because we sit in a world of a liquidity trap where traditional monetary policy has no impact. So what is my evidence of this? This is daily US COVID testing, going back essentially to the point at which we started to do statewide testing in the US. And you can see, these are daily counts. You can see, at least in the beginning of the crisis, we were expanding the testing regime in the US. And at its peak, we were doing about 800,000 tests a day in the US. That number is now stagnant or somewhat falling. Arguably, this measure today is the new sufficient statistic for macroeconomics. A sufficient statistic is an idea that everything you need to know about the world you can essentially collect in one measure. And I would argue this measure of daily testing is that sufficient statistic when you think about macroeconomics. So let's talk about the macroeconomic assumptions that are driving the industrial forecast. Assumption one. Real GDP will contract through the end of the year, contract by about 1.4% in both Q3 and Q4. Quarterly growth will be very low at about 1.25% each quarter in 2001, and will drift back down to about 1% for the first half of 2022. Average unemployment rates this year, about 9.3%. Next year, 6.5%. The year after, 5.5%. So these will be elevated relative to the very low unemployment rates we have been accustomed to in the US. And in turn, we will see inflation rates of 1% this year, 1.5% next year, and about 1.7% in the following year. Now, those of you who are students who have taken my data analytics class know what I now do with these. I drop them into a model. That model learns from the past. And because it's learned from the past, it can make a prediction of the future. So that is the quarterly demand forecast for industrial space. Let's have a look. This is net absorption of industrial space going back to 1990. In blue is actual absorption. So this is the net absorption of industrial space going back to 1990. And in black is the forecast. So the algorithm learns from the past. It then takes my assumptions and makes a forecast based on that. So we're going to see a considerable contraction in net absorption, in demand for industrial space for about the next 2 years. And then it will recover to levels that are consistent with levels that we've seen or that we saw during the prior expansion. Because again, all of the things that favor industrial have not changed and arguably will accelerate. The relative demise of retail has driven outsized performance in industrial. Again, those of you who have taken my class know that that's the best forecast, but I can provide a confidence interval around that forecast. And in blue here is an 80% confidence interval. Why do I give such a wide confidence interval relative to a standard I would teach in class? Because of the current state of uncertainty. The way I feel comfortable reflecting the current state of uncertainty in a study like this, in a forecast like this, is essentially to use larger confidence intervals than I traditionally would teach in class. But Savage, how good is the model used to forecast? Over the past, I do this for industrial twice a year. So over the past 10 half-year forecasts, the mean squared forecast error, which is to say the deviation from actual once it's observed, is about 7%. To give you some sense of the space that 7% amounts to, it's only about 14 million square feet across the entire US, across all of the major markets that are tracked by CBRE. So this is, I think, a fairly reliable forecast, and in time it will essentially become a Bayesian forecast. So you can do your own sort of confidence intervals. So with that, I want to thank you. The slides are on my GitHub page, and we have put you on mute, so please feel free to ask any questions in the Q&A box. Okay, very great question to start with. What does the net absorption forecast imply for rental growth, given the historical relationship? Rental growth is something that's much more difficult to forecast relative to forecasting overall demand. I think the way I think about rental growth is rental growth in industrial relative to what other asset class. I would argue that rent growth in industrial space will continue to, relative to, say, office, certainly relative to retail, will continue to outperform. It won't necessarily be as strong as it has been during the past economic expansion. But Amazon, for example, continues to lease large amounts of industrial space, I presume on the presumption, or their presumption, that we will continue to see a strong expansion in e-commerce. So relative to what I think is going to be rent growth on the office side, certainly relative to rent growth on the retail side, rent growth in industrial will be relatively stronger. And outsized rent growth in industrial will be dependent on that industrial space that is very close to dense urban clusters, where essentially you can do same day delivery. Another excellent question. Wearing my Bayesian hat, would I be tempted to adjust my forecast in either direction by virtue of this being a viral pandemic? Interestingly enough, a Bayesian approach to this is enhanced in a world where we might have seen changes in relationships from the past. Bayesian approaches allow us to incorporate the potential for seeing so-called regime shifts. Arguably, this is one reason I want to move in that direction. So the simple answer is I would use a Bayesian model to reflect the fact that historical relationships in the current pandemic may have changed, and therefore the reliability of any forecast based on historical data may be more limited. So again, very, very good question. Give it another, say, minute, see whether there are any other questions. Otherwise, we'll conclude. Good. I think it's safe to conclude. Thank you for joining us today. Please continue.